As you move to the next section of the business plan, financial projections, ensure your financial projections match your funding requests. All possible credit sources will be on the lookout for inconsistencies, and few, if any, will allow you to correct problems they have uncovered. It's much better if you catch mistakes before they do. It can mean the difference between approval and decline. The financial structure of your business is its foundation. Therefore, the financial projections section of your business plan is critical to write well. This important section explains your revenue forecast, how much money you have and need, and when and how the business expects to make a profit. It also details what your marketing and operational processes and plans will cost. To clarify your business's financial situation, the financial projections section of the plan includes economic estimates and 3 financial statements: projected balance sheet, cash flow projection, and profit and loss income projection. This section of your business plan is considered the most important as it outlines the complete financial situation of your business. Therefore, ensure this section is reviewed by a financial professional, such as your accountant. Total suggested page length for this section of the business plan, 12 to 25 pages. The financial performance of any business is measured by the interrelationships among 6 essential elements. These elements comprise the 3 financial statements: projected balance sheet, cash flow projection, and profit and loss income projection, and are revenue, expenses, profit losses, assets, liabilities, and net worth. A business will prosper or fail based on the owner's effectiveness in planning and controlling these components. The projected balance sheet represents the basic accounting equation: assets minus liabilities equals net worth. A balance sheet is made up of assets, items of value, liabilities, debts, and net worth, equity, or the difference between a company's assets and liabilities. The balance sheet provides a measure of a business's value at a particular point in time. It is considered a snapshot in time. The cash flow projection is a valuable tool that monitors and projects the amount of incoming and outgoing cash during a given period, usually monthly, to gauge financial performance. It helps you determine how much cash your business has on hand at any point in time. If your business has a negative cash position, it means that you have more money going out than coming in and may find paying your bills somewhat challenging. The cash flow projection shows you if your working capital is adequate and helps you determine how much and when you may need to borrow money. Don't forget to account for things like selling or buying on credit or regular expenses. The profit and loss projection is a measure of how a business's income has performed over a specific period of time, usually 6 months or 1 year. It measures all income less all expenses to arrive at the amount of profit or loss generated by the business for that period. The profit and loss projection is also called an income statement or an income and expense statement. If you're adding proposed loans into your business plan, include the sources, amounts, and terms in the financial projections section of your business plan. If you have or plan to get investors, include how much will be contributed by each investor and what % ownership they will have. If you are submitting your business plan to a bank because you are applying for a loan, you should also include a current personal financial statement on each company principal and a copy of your business or individual federal tax return for the last 3 years. If you are a new business, all of your financial statements should be projected 1, 2, and 3 years forward and include accompanying narratives to explain any assumptions. It should also include a break-even analysis. Do your sales projections from the previous section indicate that you will reach your break-even point? Do your research to accurately determine all of the potential costs and projections. Explain when you expect to become profitable and how you arrived at that conclusion. If you are an existing business, you should include current and prior projected balance sheets and profit and loss income statements, ideally for the last 3 years if available. Then include projections for the next 3 years. You should also include current 12-month cash flow projection statement that predicts the flow of cash several months forward. Include your business tax documents for the last 3 years as well, if applicable. If you plan to introduce a new product line, or if you will require a large influx of capital up front to grow your business, consider adding a break-even analysis. Remember to include accompanying narratives to explain any issues or assumptions in your plan.